Hello and welcome. Today we're working on what if Michael Saylor's $13 million Bitcoin prediction is right or wrong. Let's check how it works. If you're new, my name is Jeff from Finally Learn. Here's what we're going to look at. Michael Saylor says in a recent article, hey, in 20 years, and by 2045, that he sees Bitcoin being $13 million. So he thinks that we'll deliver a annualized rate of return of 29% over the next 21 years. Right now, we've been the last 5 years about 60% annualized return, and the volatility will decelerate or decrease. All right, so let's look at, we're going to do a Bitcoin Monte Carlo simulation and kind of see, what this would mean. Okay, so let's say assume that our compounded annual growth rate, we're going to use his 29%. Over the last 5 years, I pulled the numbers right before the video. The standard deviation is like 75%. So let's leave it right there. Let's do our calculations and then reduce the standard deviation and see how that helps us out. So let's say right now the price, as of today, I'm filming this in January 5th of 2025. It's like 98,500 or something like that. So in fact, let's do that. I don't even have to guess. BTC USD, if I go to the data ribbon and do currencies, then I can pull, what is the price? The price is I'm a little bit high, so $98,093. Now that price might update as we're building this spreadsheet as we're working on this video. Okay, so let's do this. We have a way to simulate, so let's simulate with using random numbers. If we know this is the mean return and this is the standard deviation. So we're going to use a function called the normal inverse. So what's our probability? I'm going to pull a random number. And I've got lots of videos on Monte Carlo simulation, so check out some of those videos if you're new to Monte Carlo simulation. I'm just trying to apply this simulation to Bitcoin specifically. So the mean is going to be, let's say 29%. I'm going to make that absolute with F4. And the standard deviation is going to be 75% right now. Make it absolute with F4. All right, so I'm going to do that. And so what we have is we've randomized, and we need to make this a percentage. So give it a couple of decimal places. So instead of 29%, it's now 53. And what happens is every time I do something, it's going to be volatile. So you see down here it says volatile. That means it's going to randomize a number and then pull from the distribution, the normal, assuming a normal distribution. All right, so we can do this all the way down. So here's what we have. We have 20 years. We have 20 years. In fact, we don't need the very first year. We need 25 all the way down, right? So these are the randomized numbers that might happen if we have a mean compound annual growth rate of 29% and standard deviation of 75%. Now, that may be high standard deviation, but let's just start from here. Well, let's say that our beginning price, we know it's 98,000. Let's just start with 100,000. So I'm going to say, well, we started at the end of 24 with 100,000. Well, what would happen if it went 100,000 times 1 plus that 12%? Now that 12% will change. As soon as I hit enter, it changes to negative 35% basically. And so we're going to use that all the way down. Same formula. Well, what would happen if we had this? Well, in this scenario, we had a $37 million Bitcoin, and then it went down to 5.5 million Bitcoin. That's lots of volatility. You can see how that works. Okay, so that is one simulation. So we're going to put the future value is right here, the one simulation, the ending value in 2045 is the 5 million. But as soon as we hit enter, it's going to be a little bit less. It's going to say it's negative 1,866,000. Now, I don't think we can have a negative number here, really. it would just go to zero, right? So the future value would really go to zero now rather than negative 1.8 million. But every time we change it, it's going to update. So now let's do this 1,000 times. I just did a column where I have 1,000 different CIMs. So I need to highlight all this all the way down. And I'm going to use under the data, I'm going to use the data ribbon, the what if analysis, the data table, and I have a column that's 1, 2, 3, 4, 5, whatever. Now, I'm not going to change any inputs, so I'm just going to use a blank cell, not a blank spell. I'm not Harry Potter, right? A blank cell, H1, and put OK. And what's going to happen is it will, we'll see in just a minute, it will recalculate that based on these numbers, okay? So we go all the way down, we see we have wild variations of these numbers based on these original numbers. So we'll modify this a little bit. Some of them we've grown to 4,800, some 6.4 million, a lot of negative numbers, some to 14 million, so on, okay? So let's do this in terms of the percentiles. If we have this information, okay, let's call this, in fact, let's name this entire range. Let's name it BTC, Bitcoin Future Value. How about that? BTC FV, okay? So now what we're going to do is we're going to say, I'm going to use a percentile function. So percentile, including the 10%. So my array is called BTCFV. You see it right here. And I'm going to comma, and I'm going to do the at the 10%. So how much would we have at 10%? Well, we have a negative number, okay, and then we're going to do this all the way down. What would be the 50%? The 50% here, it's 8,176. So the problem here is if we have compounded annual growth of 29%, our standard deviation is way, way larger than that growth rate, and we could have lots of negative numbers. We don't want that. So let's do this. Let's assume, let's start changing what the numbers might be for standard deviation. Let's say, I know in 2024, our standard deviation was about 50%. So what we have is now the numbers get a little more positive, right? A little more predictable because the standard deviation is less. So right here, the median value is the same as the 50%. So that's 2.7 million. So let's do it where this number might approach 13 million, like Michael Saylor's estimate. So 50%, let's go down to 45%, and you see that the 50 percentile, this is the mean, right? So it's around 5 million. So let's say that we have 40% is our standard deviation. Well, it's 6.6. 40%, let's do it 35%. And now we have 9 million as our mean. Let's do it down 30%. I'm just guessing. I don't know the numbers here. 30%. Let's do 25%. That's above. So let's do 28%. So that's close to the mean of the 13 million, the Michael Saylor's prediction. So, look, we don't know the future. No one knows the future, right? But let's say that we believe in this $13 million valuation, right? Michael Saylor at the end of 2045. Well, what would happen? Well, this implies that this 29% return would have a lower standard deviation, maybe around 28% or maybe 27.5%. That may be the wrong direction, 27%. And so what happens is, so maybe our standard deviation is something around 28% if we have a compounded annual growth rate of 29%. Fascinating to think about. We can certainly do this with Monte Carlo simulation, but what would happen is if you had 100,000, then the price might go up, in a random, you know, with volatility, but if the volatility is reduced, it might be 28%. So it might be compounded annual growth rate of 29 and standard deviation of a similar number.